Hello, everyone, and welcome. Today, we are going to do a complete one-shot revision of one of the most important topics for your FM paper, ratio analysis. We're going to build a powerful analyst's toolkit from the ground up, one that will help you tackle any practical question that comes your way. So let's get right into it. Okay, picture this. You're in the exam hall, you flip the page, and you see it. A massive balance sheet, a full profit and loss account, and then that one simple-looking question. Comment on the financial position. And for just a second, you freeze. It feels overwhelming, right? Like, where do I even start? Now, listen up, because this is the #1 trap where students lose marks. The first instinct is to just start writing. Well, the company's sales are 10 lakhs, the profit is 1 lakh, and total assets are 15 lakhs. Let me be very clear. That is not analysis. That's just reporting what's already there. And in the ICAI exams, reporting gets you a big fat 0. You have to interpret, you have to compare, and you have to conclude. To see exactly why, just look at this slide. We've got two companies. At first glance, Company B looks way better. It's got double the sales and more profit than Company A. So it's the obvious choice for your investment, right? Well, not so fast. Take a look at its assets and its debt. All of a sudden, that simple picture gets a whole lot more complicated. This proves that raw numbers don't tell the whole story. In fact, they can be pretty misleading. And this is exactly where our hero comes in, ratio analysis. Think of it as the ultimate toolkit that lets us look behind these raw numbers. It's what helps us compare apples to apples, understand the real relationships between all these figures, and uncover the true story of a company's financial health. Okay, first things first. Before we can analyze anything, we need to know what we're working with. Where does all this financial information actually come from? Our main sources are, of course, the company's own financial statements, the P&L, the balance sheet, and the cash flow statement. Oh, and don't ever forget the notes to accounts. That's where all the hidden gems of information are. We can also pull data from annual reports and even outside sources like business magazines. These are basically our raw ingredients. All right, let's open the first tray of our toolkit. This one is all about short-term survival. We're talking about liquidity ratios. This really answers the most basic question of all. Can the company actually survive the next year? Before we even start dreaming about long-term growth or huge profits, we have to know if it can pay its suppliers, its employees, and its short-term loans on time. That's what liquidity ratios tell us. Inside this liquidity tray, we've got 5 key tools. We have the current ratio, which is our first line of defense, then the quick ratio, which is a much stricter test. We've got the super strict cash ratio, the basic defense interval to see how long we can survive, and finally, net working capital, which is our absolute safety buffer. Let's start by comparing the two most common ones. The current ratio just takes all your current assets and puts them up against your current liabilities. It's a decent first check, but the quick ratio, sometimes called the asset test ratio, is way tougher. It asks a really important question. What if you can't sell your inventory quickly? So it takes inventory right out of the equation to give us a much more realistic look at a company's ability to pay its immediate bills. And here's a huge exam tip for you. ICAI loves to test the logic behind the quick ratio. In your answer, you have to state why inventory is excluded. The reason is it's the least liquid of all current assets. You can't just pay your suppliers with a warehouse full of stuff, right? This single point is where a lot of marks are either gained or lost. Now, the cash ratio is the most conservative test of all. It only looks at pure cash and things that are basically cash. The basic defense interval, on the other hand, answers a more dramatic question. If all your revenues suddenly stopped today, for how many days could the company keep paying its bills? It's a very practical way to measure a company's immediate toughness. Okay, let's move on to the next tray in our toolkit. We've checked for short-term survival. Now it's time to look at the company's long-term stability and its risk. We're talking about leverage ratios. The big question here is all about balance. Is the company being financed by its owners, or is it running on borrowed money? These ratios tell us about the long-term capital structure, and they're super important for lenders who, want to be absolutely sure they're going to get their interest and their principal back. We can pretty much split leverage ratios into 2 groups. First, you have capital structure ratios, which look at the mix of money on the balance sheet. And second, you've got coverage ratios, which dig into the profit and loss account to see if the company is actually earning enough to cover its debt payments. So let's look at a few key ones. The proprietary ratio tells us what chunk of the total assets is actually financed by the shareholders. A higher ratio here means more stability. Then there's the capital gearing ratio, and this one is all about risk. It compares funds that have a fixed cost, like debt and preference shares, against the owner's funds. A high gearing ratio, that signals a lot more financial risk for the company. And when it comes to coverage, the king of all ratios is the debt service coverage ratio, or DSCR. This is a banker's absolute favorite. It calculates how many times the company's cash profits can cover all of its debt payments for the year. And that includes both interest and the principal repayment. A DSCR of less than 1 is a massive, massive red flag for any lender.
Okay, toolkit tray number 3. We know the company can survive in the short term, and we get its long-term risk. But how well is it actually using its assets to generate sales? This is where activity ratios, or as they're more commonly known, turnover ratios, come in. These 3 ratios are all about the efficiency of the company's main business cycle. A high inventory turnover means products are just flying off the shelves. A high receivables turnover means the company is awesome at collecting cash from its customers, and payables turnover shows us how quickly it's paying its own suppliers.
Now, this is a really important point that connects the different parts of our toolkit. Don't think of these ratios as separate things. A company that sells its inventory fast and collects cash quickly is naturally generating liquidity. So strong activity ratios directly lead to strong liquidity ratios. ICIA absolutely loves it when you can show these connections in your analysis. And here's another critical exam tip. If a question gives you both opening and closing balances for inventory or debtors or any asset, you must use the average to calculate the turnover ratio. Why? Well, because sales happen over the entire year, right? So the number you're dividing by should also represent the whole year, not just a single point in time. ICAI specifically checks for this to see if you really understand the concept. And now for the final category of ratios, the ones that, let's be honest, get most of the attention: profitability ratios. At the end of the day, is the company actually making any money? Let's break down profitability layer by layer. The gross profit ratio looks at the basic profitability of the product itself, comparing sales to the direct cost of making it. Then, the operating profit ratio goes a step further and measures the profit from the main business operations, after things like salaries and rent are paid. And finally, the net profit ratio is the bottom line. It shows what's actually left for shareholders after every single expense, including interest and taxes, has been wiped out. So we've built our entire toolkit. We have tools for liquidity, leverage, activity, and profitability. But hey, a toolkit is pretty useless if you don't know how to use it, right? So let's talk about putting it all together for the final report. It is so important to remember who you're doing the analysis for, because different people care about different things. A shareholder, they're hunting for profit and growth, so they're looking at EPS. A lender, like we said, just wants their money back, so they are laser focused on the DSCR and leverage ratios. And what about management? They use the entire toolkit to figure out how to steer the ship. Your analysis has to be tailored to what the user actually wants to know. And finally, just a quick word of caution. Ratio analysis is incredibly powerful, but it's not magic. It has its limits. Remember, it's based on historical data, so it doesn't predict the future. It completely ignores non-financial stuff like the quality of management. And yes, financial statements can be manipulated through window dressing. But most importantly, a single ratio all by itself is completely meaningless. It only becomes useful when you compare it, either to the company's past performance or to the rest of the industry. Mentioning these limitations in your exam answer shows you have a much deeper understanding. So let's go all the way back to where we started. Company A versus Company B. Who gets your investment? I'm not going to give you the answer, because now you have the toolkit. You can calculate the liquidity, the leverage, the efficiency, and the profitability for both of them. You can compare them, you can analyze them, and you can draw your own well-informed conclusion. You have the tools. You are the analyst.